Most e-commerce businesses and even accountants are getting this wrong. If you don't understand your cost of goods sold, you might be losing money without even realizing it. So let's go through what cost of goods sold is, why it's important to your business, and then how to calculate it. What is cost of goods sold? It's basically the cost to the business of the number of units you sold. So let's say you sold 10 units at £100 each. In this case, it would be 10 times 100, and that would give you £1,000 in revenue. Now you need to work out how much it costs you to sell those 10 units and those 10 units only. And our landed cost per SKU is £33. So if we've sold 10 units, we need to times that by £33, and that gives us 333. And then we've obviously got fees here, maybe advertising or seller fees. And again, they're normally around 30%. So let's put in 333 again. So our profit comes out at 333, which means our margin is 30%. So the only way you're going to be able to calculate your cost of goods sold is by firstly calculating the landed cost per SKU. So the landed cost per SKU is basically the cost of one unit. And to get that, you need to calculate how much it's cost you to get it from the place of manufacture all the way to the place of distribution. So for example, an Amazon business, if you bought from China, then it's not just the supply cost, it's actually the cost to buy the product, to inspect it, to get the freight fees, and then finally to get it into Amazon itself. So all of those costs need to be calculated to calculate your landed cost per SKU. And you need to calculate this at the start to figure out what your pricing strategy is. Because if you don't understand your landed cost per SKU, you don't really know what you should be charging. So let's go for an example of how to calculate your landed cost per SKU and also what should be included. So the first thing you'll have is your supply cost, so the cost to manufacture. So here we put supply cost in, and let's say it was £10,000 for 1,000 units. Now people get this wrong by just dividing that £10,000 by 1,000, thinking that's the only cost, and they get £10 as a landed cost per SKU. But it totally ignores all the other costs to get it to where you need to sell it. Then you've got inspection fees. Let's say £500. Then you've got freight fees. So you can ship it over to the country you're going to sell it. Let's say £1,000. Then you've got VAT, which you maybe can't reclaim. So that's a cost. So you want to say that's £1,500. And then we've got packaging. You might need to package that product before you can actually sell it, say in Amazon warehouse. And let's say that's £200. And then you've got customs and duties. £150. And then finally, something like brokerage fees. Maybe you had to talk to a broker to get that, and that was £50. So altogether, that's cost me £14,400. Now, to get my landed cost per SKU, I know I've got 1,000 units. So all I need to do is divide that total figure by 1,000. So that gets me £14.40 as my landed cost per SKU. So basically how much each individual item has cost me to get to the market. As a rule of thumb, your landed cost per SKU should be around 30% of your sale price. So to get an indicative price you're going to sell at, you need to divide it by 30%. So if we look at our example, we know that our landed cost per SKU was £14.40. That means I need to divide that by 30% to get my indicative price. So my indicative price should be £48. And that means I should be targeting that price to make sure I'm making a 30% margin. Obviously, if you increase that price, you get a higher margin. If you reduce that, you're going to get a lower margin. But do this at the start so you know exactly what you should be pricing your product at. So why is cost of goods important? And it's really because it's the main driver of your business, and it determines if you're profitable or if you're not profitable. What most people do is they just buy stock and put it to purchases in their accounting system. What this means is that you don't really understand your profit and loss, because it looks like you're making a loss in 1 month and then a huge profit in the next. And overall, you think, I don't really know what's happening here. And you can't understand your profit and loss. So here I've got a profit and loss. And the first thing I look at when either I take on a new client or maybe I'm looking at someone else's books is go into their accounting software and figure out how they've done cost of goods sold. because it's basically the barometer to say, can you understand your business? And I can see here that I'm just looking and I can see they've got 21K in January and they've got 14K in September. So they're obviously, all they're doing here is say buying stock and putting it straight to the P&L. And you can see that they've got a loss when they buy it. So, oh, okay, I've got a loss, but they go, oh, obviously I've got a loss because I've just bought a load of stock. And then you've got profit, and then you've got a loss again. But the problem is, overall, you've got a loss, but you don't know if it's an actual loss. You might just assume I've bought stock, so therefore it's probably fine. I did my initial calculations, it made sense. So when we actually look at it properly, we can then see that if we take, say, 99 units sold, and then we times it by the landed cost per SKU, we get the figure of 2,475. And as you can see here, they're making an 8% margin consistently, which is what we expect because you've bought stock, the landed cost per SKU is locked in, so it should be a consistent gross margin. But they're not covering their overheads because they didn't factor that in, and because they're not looking at their accounting software, they're not looking at other costs, they're just looking at gross margin. And you can see here is that they're actually just repeatedly losing money. And in this case, their underlying profitability is negative 7%. So they've invested in stock and they've just lost 7% every time they invest in it. So then let's look at, say, a business, another business. And again, they've done the same thing. They've done 14K of stock, 14K of stock. And they're doing the yo-yo is what I call it, where it's profit, loss, profit, loss, profit, loss. And they still don't know if they're making a profit or not. So again, when we recalculate this, and this person obviously calculated their landed cost per SKU and did it correctly, because you can now see that they've got 99 units at £14.40. This is the same example as before. And you can see now, okay, they've got a cost of goods sold of £14,025. And you can see here they're making a consistent margin of 30%. And that means they can cover their overheads quite consistently. And then the margin only goes up when they make a higher volume of sales, because overheads are normally static. So if you're making a higher volume, getting more gross margin, it means you're contributing more to those overheads, which gives you a better operating margin. And in this case, their underlying profit is 15%. So every time they buy stock, they can make 15% from it. And normally it's not just the business owner who's doing this wrong. Normally an accountant who is used to other businesses will come and do their year end, and they'll say, what is your stock figure? And then do an adjustment on their accounts. But the problem is that's like 12 months too late. You've already made the loss. If you were doing it month in, month out, and looking at your profit and loss, calculating your cost of goods, you'll know if your business is profitable or not. So by doing this right, you can actually make decisions and say change pricing, or maybe change your advertising, or maybe just ditch the product. And the problem is, if you're not doing it correctly, you just don't know if the business is profitable or not. When I look at those profit and losses, I don't understand if they're profitable or not, because they've just not calculated it correctly. So what do you need to do to make sure that you understand your profitability when it comes to cost of goods sold? Is firstly calculating your landed cost per SKU at the start and deciding what a decent pricing strategy is. And then every month, using that landed cost per SKU, timesing that by the volume of units you've sold to get a cost of goods figure, so you can understand your profitability, and then add that to the entire picture and actually understand your business. If you've been making these mistakes, there's no better time than now to fix them. So we've got an Excel template which we actually share with our clients, and we've actually included that in the comments below, so go down there if you want to download it. Make sure to like and subscribe, because we're going to be releasing more videos on how to keep your business profitable.